turning to the banks now, banks are overstaffed given the environment right now. How much cutting are we going to see?
We've published between 40 to 80,000 job losses on Wall Street, and that's a domestic number. And the math works this way. 70% of Wall Street's revenues came from Europe and the U.S. over the last 10 years. And Europe and the U.S. are the slowest growing, if not contracting, regions within the global markets. So BRIC countries are doing incredibly well. There just has to be a reallocation of resources, and U.S. banks are overstaffed in the U.S. and in Europe. So I just don't think that the revenues support the onerous expense structure. And really, there have not been job cuts since 2008. So I think it's a natural progression anyway.
When do you think those cuts come? I mean, 80,000
U.S. workers
we've
said over the next 12 months.
In the next year. Going to be a harsh awakening for the industry. What about bank payouts? I mean, do we see a big compensation structure change, do you think?
Well, given the fact that the revenues have been far weaker than anyone would like, compensation clearly will come down. And the other thing is there has to be an offset to higher regulatory costs. So non-comp, which is typically around 20% of revenues, is rising, and the offset will be comp will have to come down.
Do you like any of the major banks right now as an investment, especially given Dodd-Frank and the fact that a lot of these rules still have to be written?
The large banks would have to get a lot cheaper for me to like them. I mean, at some price level, I like them.
Sure.
And there's some financials that I like as well, but I think that there's going to be an opportunity to get a lot of these names a lot cheaper. On a regional basis, just the business model doesn't make sense to me. Why we got into this entire state analysis is we strongly believe that coming into this recovery, certain states will outperform and underperform others. And so regions like Florida and Georgia are going to markedly underperform the rest of the country. And so if you're exposed to that area, there's not a lot you can do to deflect sagging economy, and home prices suffer more greatly there. You have the highest foreclosure inventory within Florida, so save like being a great bank in Texas or a great bank in Virginia. This is again why the state analysis is so critical to our research. It all comes back to the states.
Fascinating. Just quickly, your take on housing and where we are in that recovery, further pain ahead.
Well, just due to a supply-demand issue, we've believed this for over a year now. There'll be a double dip in housing, and we think you're going to start to see that end of October with the Case-Shiller number, at the latest end of November with the Case-Shiller number. Banks are trying to get rid of inventory. There's not a lot of demand, and imagine a whole swath of home buyers are kicked out of the market because they can't qualify for mortgages anymore. There'll be another leg down in housing. And look at where most of the housing inventory is: California, Florida. Nevada is in a very tough spot. Nevada's not on our radar screen because it's just too small, but huge negative equity positions. It has to sort itself out, and I would hope that the government will let the housing market sort of sort itself out, find its own bottom. But for a year, we've been delaying the inevitable.
Through government programs?
Through government programs such as modification programs. This whole foreclosure mess that we're in right now delays the inevitable. And you want people to get secure, be either in a rental property they can afford, in a home they can afford, but you got to let the market sort itself out. Then you have a stasis level where you can go from and grow from.